RIMM Research in Motion hits new 52-week low, $9.97. Romeo India Michael Michael hits new 52-week low.
All right, I'm just getting set up here. Just excuse me, just a second. I just want to make sure I got everything right and ready for this interview. Sorry for that AUTH here. Going to go over the screen here. Let me turn down the audios over here and give Martin a call. AUTH here continue to push higher. AUTH continue to push higher. Again, rumors out there of iPhone maybe adapting its technology to the new iPhone. That would be a grand slam for this company. Grand slam. Pring. PRGO here pushing a little bit higher. All right, guys, ready? Let's see. Did I get any emails on this anyway? I'll just. AMAT here now starting to lose a little. AUTH here. Again, hanging up here. You know, we don't know what's going to come from this, but, you know, definitely we have some good profits in it now. Most likely these rumors are always false. And just remember that, you know, when you have a nice profit, it's, you know, hoping for the stars sometimes is not the best thing to go by here. But again, a cheap enough stock, you know, something maybe, you know, might see some follow through. All right. AUTH, the one that's on the board right there. We'll just move it over here a little. All right, so let's give Martin a call. Oh, let's see what we got. Hold on one second. All right, here we go. Give him a call. Oh. And I lost it. Try that again. Okay, one more time. So let me double check I got everything up and running right. No, it's on the United States. It's on the United States. It's on everything else here. It's actually an area code I'm very familiar with. It's like an area code around here. Well, this is not working out too good. Alright, let me double check something here. Alright, I'm gonna call this other office I have. Alright, let's see. No, because just dialed the other number correctly.
Pring Research.
Yes, Martin Pring, please.
Speaking.
Martin, I tried to call you on your other line, but I was getting cut through. This is John Carisco, Day Trading Radio.
Hi, how are you?
Is it okay if I call this number? Because I tried to get through that other number we had.
The other one didn't go.
No, it didn't.
I heard it ring and I picked it up. And
yeah, maybe it was through the Skype or something. It just wasn't working properly. Was it an international number?
No.
No. Well, anyway, I'm glad I'm talking to you. You're live on the air, and I'm very honored to have you on our show. It's been a great experience. A great experience reading your books throughout my trading history, and we have a lot of people out here that really thrive on technical analysis, and I feel like you being a guest on this show is really the holy grail for me. So I appreciate that a lot. Yeah, I just wanted to reach out to you, and because I've learned so much from you, I'm very curious, because the reason I got your name in my head, I was watching the markets from last week, and we started breaking down, and a lot of people were coming out talking about Dow sell signal. We talk about the Dow signals, and I said, well, why don't we ask one of the the more world-renowned technical guys out there what kind of market we're seeing right now, and exactly what you see of this.
Well, I think we're in a very interesting period, because if you look at the world market, for example, the world ETF, the MSCI, world stock ETF, the ACWI, at the end of the last week, which is of course the end of the month, it fell below its 12-month moving average, which I regard as a very good objective bull-bear benchmark. And it's also fallen below its 65-week exponential, which is another major bull-bear benchmark. And so it looks to me as if the world is in a primary bear market. But when we look at the U.S., we get a mixed picture. Because if we look at the NYSE Composite, which is the broadest measure of NYSE stocks, we find that that's below some key moving averages, but the S&P isn't. So it's kind of a mixed picture where things are beginning to tip over, but not decisively into a bearish mode at this point. But we're being dragged down by the rest of the world. So it could be a very serious situation here in terms of
as a person who really, I mean, when you started trading, or you started, technical analysis back, was it in the 60s, right? In the late 60s, right when I was basically 60s, born. Yeah. And how did you go about developing your style of analysis?
Well, I just read a lot of books and plotted a lot of charts. And did you see certain things work over and over again? To some degree, yes, but even the best, there is no holy grail. That's the thing I've learned over the years. I've learned a few things, I guess. One is there is no holy grail. Never go for perfection. Always go for consistency, because perfection doesn't exist. Because we're dealing, the second thing I've learned is that prices are determined by psychology. And psychology is people in action in markets, and people can and do change their minds. So markets can and do change their minds. So that's why there's no perfection in technical analysis. It's an art form where you come up with several different indicators, put them together in a kind of an art form or a framework, and then interpret those in the best way you can.
Wow. And then, how do you, in this environment today, with all the news that's coming out of Europe and all the news that we have here, with everything that, the media, back in the 70s, the 80s, and 90s, you never had this focus on the markets where you don't even, now you hear a small little report come out of a country or a downgrade and the market reacts. How does that play into technical analysis? I find it very hard to sometimes rely on something. It's almost like it's a casino.
Well, I think you have to ignore the news as much as you possibly can. The only time then, because it's all in the charts, and that's what you've got to interpret, what's in the charts, and try and understand the psychology in the charts. That's what's going to help you, not listening to the news. Mm-hmm. The news becomes important when bad news, when the market, for example, becomes, it doesn't go down when you have bad news, when it starts to go up. For example, we're seeing a sell-off right now. Maybe this sell-off, and I'm just speculating here, I'm not forecasting, maybe this sell-off goes on for another couple of weeks, and we're say 100 points lower in the S&P or something, and then the euro breaks up. Well, that's probably, the initial news may send the market down, but that's probably going to be the point when when it's all factored in, and that bad news will actually cause the market to rise because it's now out of the way. Everyone knows it's there, and the market can rally. So that's the only time I think news is important, is when you see what the market's reaction to the news is, and the market's reaction is unexpected to what you would expect the news to deliver for the market.
Oh, that's an excellent point. That's an excellent point. And we always talk about how seeing the market really factors in or prices in a lot of the events, and by the time the events play out, the market's already at that level. I mean, would that be the typical thing? So,
exactly.
Yeah. So when you do your technical analysis, I have some, I'm so happy to have you on the show today, Martin. I'm very, just very gracious in your presence right now. I want to ask you some questions I would love to ask you. I know we have so many listeners out there, but when you talk about, just everything's in the charts, and you read into the charts and stuff, and there's all these indicators you work with, and there's no holy grail. When you tie everything together, how does it, what do you, a question I would ask you is, for a beginner trader, where would you focus his energy on technical analysis? What are some of the basics that he should know? What are some of the things that hold up more than they don't hold up?
Well, what I would do is definitely read as many books as I possibly could on technical analysis and try and form my own opinion as to what the best indicators are that I have confidence in. Because I always tell people, I can tell you that, for example, an indicator I developed called the special K, and I have another one called the KST. I think they're the best indicators out there, but that's for me, not for them. Just as the world is divided into many different religions, they're all trying to get to the same thing. What's the meaning of life? What's the truth? But people have different approaches to doing it and getting there. And I think the same thing is true in technical analysis. So that's why I encourage people to read widely a lot of different books on a lot of different subjects, and then come to the conclusion which indicators they feel comfortable with, not necessarily the ones that I'm comfortable with, but that they're comfortable with. Because when you're in the market, it's your money on the line, not my money.
Yeah.
And you've got to have confidence that the stuff you're dealing with is working for you.
Well, I have one of your books that I recommend all the time, and it's Technical Analysis Explained. And that's probably your most famous book that you put out. Now, you've since then have many different books out there. What are some other books that we could focus in on that really helps us in this market condition?
Well, actually, we just come out with a brand new book called Investing in the Second Lost Decade, which is a book which is more designed for investors, but it sets up the environment as we see it over the next 5 to 10 years. And when I say we, I have my two partners in Pring Capital, Joe Turner and Tom Kopus, who we jointly wrote the book. And the concept behind the book is very simple, really, is that we've been in a secular, what we call a secular or very long-term bear market in equities since March 24th of the year 2000. That's when the S&P was at 1553. Well, now it's below 1300. This is 12 years later. And when you adjust it for inflation, we're down even more. We're down well over 30%. So we're in a definite secular, very long-term bear market here. And we notice in the book that since 1900, the U.S. stock market has alternated between a secular bull and a secular bear. Each of these very long-term trends lasts 15 to 20 years. And in a secular bull, it's a buy-hold approach is the thing you need because everything goes up over time. But in a secular bear, it's a much more challenging environment. So we also point out that even though we're in a secular bear, there are these pockets of opportunity as the business cycle goes through it, as the economy, I should say, goes through the business cycle.
Okay. Well, what about a Dow theory? Do you abide by that, or do you really put a lot of emphasis into that?
I tend to think about it when other people ask me for my opinion on it. I don't usually use it as a day-to-day thing because I think it's lost a lot of its luster, and I just don't feel comfortable in using it as I would with other indications. See, what I do is I sort of will say, conceptually, I'll have maybe 5 or 6 different indicators I'll look at, and one of them might be Dow theory. But if Dow theory is bearish and all the other ones are bullish, I'm going to go with all the other ones rather than with Dow theory. All
right, I want to ask you some real basic questions, like some of your indicators that you typically follow when you talk about using Dow theory as an indicator. The indicators that I know of course, are your basic moving averages, your Bollinger Bands, your Elliott Wave theories, your Fibonacci's, your stochastics. Of those that I mentioned, any of those jump out at you as something really that you follow too?
Well, I like moving averages in a sense because they give you an objective view of whether you're in an up or a down trend. But the problem is that the shorter the time frame, and I'm talking now in terms of trends, like daily, weekly, monthly, that kind of stuff, hourly, the shorter the trend, the greater the random noise, and therefore the less accurate, in my experience, moving averages are.
Okay.
So you heard me talk earlier about the 12-month moving average for the world index and the 65-week exponential moving average. Those are the kind of averages which I look at, and I think tend to be, and I use the word tend to be more reliable than something like a 10-day moving average or a 20-day or something like that on the daily charts. So that's something I look at. But I like to keep things simple, and the most simple, most effective tool in technical analysis, well, I think there's 2 of them. One is the idea of reversals in peak trough progression, which is, of course, the foundation of the Dow theory, and a foundation building block for price patterns, incidentally. And the second is trend lines, which are also one of the basic building blocks for price patterns. And those simple tools work very well for me.
Trend lines. We use a lot of trend lines on our on the show right now, and it always plays out until it doesn't. It's always that news event that maybe breaks down a trend line or pushes it through and stuff. But definitely one of my favorites is the trend lines. How do you feel about the stochastics?
Well, as I mentioned before, I developed a thing called the KST, which does basically the same thing as the stochastic, but it doesn't give you as many whipsaws, and it tends to lead the stochastic. So
Okay.
that's what I would use. But I don't discourage anyone from using the stochastic. I think it's a pretty good indicator.
Now, you teach you have webinars and seminars. I know you have one coming up. Want to talk about that a bit? I know it's very limited. You probably might already be filled up, but do you give your webinars on a consistent basis?
No, actually, that's something I haven't done. I have given them quite a few, but I haven't given them in terms of on a regular basis out of my house here.
Oh, okay.
But it's something I'm thinking about, because I write 2 newsletters, a monthly newsletter called the Intermarket Review, and then I have a weekly info movie report, which is about a 5 to 10 minute animated PowerPoint presentation that deals with U.S. stocks, bonds, currencies, and commodities, and precious metals. And I'm thinking about turning that into a webinar where people can actually ask questions and so forth.
Oh, that would be great.
I've done a lot.
That would be great. Do you find yourself trading the markets these days? Are you a trader for life?
I used to do a lot of trading. I used to do it for a living, and as I've matured, I found it less exciting, and I'm more involved now with our money management firm, Pring Capital, at pringturner.com, where we look at the business cycle in terms of our investing, and we invest around the business cycle.
Okay. Well,
because
yeah.
the business cycle is nothing more or less than a set series of chronological sequences, and the financial markets fit into that very nicely. So my trading stuff is now more into investing, and it's with my 2 partners that I do that.
Okay, so you have a few different sites. I have on the screen right now your Pring.com, which but that'll lead to everything. I guess you'll be able to get to your firms there through that link.
Yeah. Well, there's actually 2 sites. There's Pring.com, which is a Pring research site where we have a lot of technical analysis stuff, and then pringturner.com, which is our money management arm, where we have a lot of articles on the secular trend and so on and so forth.
Where do you? I see some. Martin, I see some questions coming in on the site here, and people, asking you if you could kind of go into where do you think we are at the cycle right in your cycle right now? If there's a larger cycle be playing out here, where are we about in that level?
Well, let's take the secular trend. The secular trend, typically on average, the last 2 have lasted 18.6 years. They've experienced between 4 and 6 recessions. Well, the current secular trend began 12 years ago, and so far we've only had 2 recessions. So we think there's at least another 5 years to go before we get to the end of the secular trend. There's lots of other factors we could like the Shiller price-earnings ratio, which has moved down from 45 or so in year 2000, which is a record level, down to about 20. Well, 20 is usually closer to a top, a bottom in the Shiller price-earnings ratio that we saw in 1921, 1949, and so forth. It's down at 7.5. So in the long-term sense, we think there's a lot more of this secular bear market to go through.
Wow.
In terms of the cyclical stuff, right now our indicators are pointing to a cyclical bull market, but the indicators are starting to deteriorate. So it looks to me as if we may, and it's going to be determined by the price action next couple of months. It looks to me as we may be deteriorating into a primary bear market. It's too early to say yet. So,
is there any...
in our monthly newsletter, we have a fairly conservative allocation right now.
Okay. Is there any levels you're looking on any of the major indexes to kind of give you that edge on going long or short, or looking at which way the market's going to go? Is there a level on the S&P that you'd be looking at, or the Dow?
I think somewhere around on a month-end close basis, something like 1280, because I think that's where the 12-month moving average is.
Okay.
And then I look at a lot of different inter-asset relationships, where I look at bonds against stocks and commodities against stocks and so forth. So we try and indirectly get the technical health of the U.S. stock market. So those are a few other things I'd be looking at.
Well, you really...
So that's all bound up in a barometer called a model called our stock barometer, which consists of about 6 different long-term indicators. And right now that's showing at 58. If that were to go to 49, that would put us in a bearish mode.
Now it feels, as you mentioned that you used to trade full time and you used to trade for a living. Did you get your start as a trader, like just getting out of a job, getting some money together and say, oh, I want to trade the money and make $10 million in the stock market with my, quit your job? Or did you have background in this? And how did your journey play out? And what would you tell? And this is a question I wanted to get to, is because I do a show and I get a lot of new traders. I would say I wouldn't say investors, but I would say traders. People coming into the market and trying to trade the market to make a living. And I did that, in the 90s and 2000. But I find it, as things are playing out, and you say that we're in maybe things are deteriorating. What's your best advice for a new trader coming into this market and trying to make a living? I mean, how do you go about doing that? Just in your experience.
The number one rule for anybody, whether you're a trader or investor, before you get into a trade, you want to figure out what risk you're willing to take. In other words, if you're bullish, you get in, you've got to figure out to yourself, where's the market going to change its mind and say we're now in a bearish trend?
Yeah.
And you put your stop below that support level or whatever the indicator might be, or a group of indicators, and measure that risk against your potential reward. Because most people, when they get into a trade, look and say, okay, I'm going to get in now because I can make a lot of money. Yeah. That's the wrong attitude. The right attitude is to look down, not to look up.
There's a
reason for that too. It's a psychological reason. If you mentally rehearse where you're going to get out, you are then very objective because you don't have any money on the line.
Mm-hmm.
If, on the other hand, you get in, you think it's going up, and then some bad news comes out, you might say, well, I still think it's bullish because, and in that case, you start to take a small loss, and a small loss can go into a large loss.
Yeah.
And that's not where you want to be, because then it becomes an emotional decision, not an objective decision.
Wow. How and this is a tough question, Mike. That how do you see things playing out in the Eurozone? Do you have any opinion on that? And that seems to be so in the news, so much in the news. It's just hard to imagine an end game or how that's going to play out. And where does that leave everything?
I don't know, because I'm looking at the charts, and the charts to me don't look particularly bullish.
No, they don't.
They're quite bearish.
They don't.
If you look at the Spanish market and the Italian market, last month, those markets, well, at least the Spanish market completed a massive multi-decade head and shoulder, multi-year, I should say. I think it may even be a multi-decade head and shoulders top. The Italian market had done that about 4 or 5 months ago, and now has made a new low from that breakout. So the breakdown is now a more decisive one. So the market is telling me some pretty bad things about Europe.
Yeah.
Much worse than what we've seen so far. So that sort of suggests that the euro may unravel, or there's going to be some more extended financial crisis that takes place in Europe. The other interesting thing is the Chinese market, which a few years ago everyone's so bullish about, has gradually been eating its way lower and lower and lower. And there again, if you believe that markets look ahead, the Chinese market may be forecasting some bad things for China. Having said that, the Shanghai Composite is just a little bit below a major downtrend line going all the way back to 2007. And some of the momentum has started to turn up. So if it gets above 2,500, that's going to cause a breakout on the upside. And so that would reverse what I've been bearish on China pretty well since, August 2007 when it peaked. And that could be the signal that turns it around. But at the moment, it's still bearish and it's still discounting bad news.
Wow. So things, it is going to be a long, hot summer here.
Well, the other thing you've got to bear in mind is there's always a continual battle between inflation and deflation. And we've seen this last month, when you take a ratio between commodities and bonds, it's just completed an important head and shoulders top, indicating that commodities are going to be outperformed by bonds. That's deflationary. You can see the same thing in gold versus bonds, and you can see the same thing in a ratio between my inflation-sensitive stocks and deflation-sensitive stocks. Things like inflation would be resource-based and deflation would be interest-sensitive. That broke down about 3 months ago, and anyone goes to MJ Pring at YouTube can see a video on that I put out. And that indication, that breakdown, has happened about 6 times in the past, and it's always been followed by a very, very important move in favor of deflation-sensitive assets.
Wow. What about the bond market?
Well, the bond market is a deflation-sensitive asset, but at the same time, there's different bonds.
Yeah.
And some bonds are good quality and some bonds are poor quality. And what we're seeing now is the spread between governments and investment-grade BAA Moody's corporate bonds is reaching, this month, it's reached to its lowest level since 2008. And we're seeing obviously the same thing in Europe, where the poorer quality sovereign debt, like Spain and Italy, is widening out against better quality stuff like Germany. So the German, Japanese, and U.S. government bond markets are doing very well right now. But when you look at poorer quality bonds, not so much.
Yeah.
And that's typical of a sort of a deflationary trend.
All right. Well, I mean, there's a lot of great information that you brought to us. I also wanted, while you were on the station, I also wanted to throw out the invitation to always, feel free to come back on and use Day Trading Radio as a vehicle. We'd love to hear more of anything that you see out there and get some of your analysis out there and some of your webinars. If you start doing the webinars, we'd love to actually have you come on the site and actually do a webinar if that's possible. You have so much information, Martin. There's so many. Anybody in the room want to just ask a fast question while you have the opportunity? I was going to ask you just a couple questions, just fast. Like, what's a typical day for you now? I mean, I know it's a kind of, but you have to look at it as a trader's point of view. That your book actually really was there when I started trading back in the early '90s, and I have always recommended it, and to be able to talk to you and to see all the time and effort and to hear the knowledge, and as people were saying in your in the chat room, the calmness in your demeanor and the way you present yourself is very it's very balanced and it feels good. And what got you to this point? Was there what do you do during the day now?
Well, I don't have a typical day because sometimes I'm out giving talks, in Asia or Europe or somewhere.
Okay.
Other days, I'm Thursdays is my typical day for writing my info movie report and doing the voiceover for that for early Friday morning distribution. Last week, I was completely doing the intermarket review, which is a 50-page roundup, long-term technical roundup of the world's principal financial markets. A week before, I was out making a presentation to the trustees of advisor shares because we're coming out with an ETF which is in registration right now. So I do lots of different things.
So you're keeping yourself busy. I didn't hear anything about fishing or taking the boat out.
Not at the moment, no.
No. So you have
we have a lot of things going on because last year I developed a new index with Dow Jones indexes called the Dow Jones Pring Business Cycle Index. And that's the basis that we're using for our ETF, and that looks at the business cycle and which is the best time in the business cycle to invest in certain assets and so forth.
So this is going to be an
ETF, which goes back to the 50s. So there's a lot of stuff going on right now in terms of development stuff that's coming to the fore.
I have another good question that just came through, and I'm surprised I haven't touched base on this. What do you think about QE3? Does it happen? If it happens, when does it happen?
I don't know. I don't really care.
Yeah.
From the point of view of, I don't mean to be facetious, but from the point of view of the charts tell everything, and you have to let the market make its decision. Because if you try and come up with these concepts, and you're trying to forecast what the market is going to do when they do QE3, but you don't know what else is going on at the same time. Maybe these rated bomb Iran or something at the same time, so a positive is offset by a negative. So it's very difficult to sort of pinpoint exactly what these things are going to do and what they're going to mean.
Yeah, it is.
And right now, interest rates are so low that I can't see another Q is going to help much in terms of stimulation. Interest rates have already fallen. That should be positive for housing in its own right.
I know. More dreary. What is the worst case scenario? Do you see playing out? I mean, what could?
I don't have a worst case scenario.
Yeah, that's a tough question. I don't. I'm asking all the questions I want to hear. Anyway, Martin, you've been a fantastic guest. I hope we get to talk more. I really appreciate you coming on.
Okay,
great. I know you're down in Florida, right?
Correct.
You get 90-degree weather down there, and you're a great
guest.
Well,
Florida. People think. I used to think before I moved here that Florida was very hot, and it does get hot. There's no question in the summer. But it actually I used to live in Virginia, and it gets hotter in Virginia in the hundreds. It never goes above 95 down here where we are.
You're down in Sarasota?
Of the, Gulf. I've never seen it higher than 95. And you know, in the summer, there's lots of days when it does reach the 95, but it doesn't go into the hundreds like it does up north.
What do you do for entertainment?
Well, I like to listen to jazz a lot.
Jazz, oh, nice. Jazz, and who's your? Do you have a like? I'm not a big jazz person. We play a lot of rock and roll on the station and stuff. There's a couple people that like jazz and stuff, but yeah. But anyway, Martin, great to have you on. I really appreciate it. I'll follow up with an email. Hopefully, we'll get you back on. Like I said, anytime you want to come on, just let me know. I would love to have you back on.
John.
I appreciate it. Have a great day, and I'll talk to you when we talk.
Thank you.
All right. Thanks so much. Bye-bye. All right. Wow, that was a lot of information. A lot of stuff. A lot of stuff over my head too. All right. If I missed you guys' questions, I apologize. I feel like he gave a good interview. Thanks, Gas. And he's one of the renowned, technical guys in the world. I mean, he is. You check out his site. Check out his. If you don't know Martin Pring, it's a great honor to have him on the show. I feel like that was a great thing. If you're out there, Martin, I appreciate it. Well, I saved that. I saved that interview. I want to put it. Excuse me. We're going to put it in the members forum so you could catch up on it. You know who would love that interview? Too. Money Changer would have loved that interview. I know Gas. That was a good interview. Amazon's starting to push back up. I would say he comes off. He's very balanced, right? There's a little Zen quality about his way he speaks. Oh, I missed your bond question, Vin. I'm sorry. All right, so markets here still stutter stepping around 1270. Let me, what I'm going to do though, I'm just going to lock this interview up. I want to turn off the show just for a second. That way, I'll lock that in. We'll get that posted on the forum, and then just going to come right back on. Just give me 5 seconds. The show is going to go off and come on.